Welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have Euro-USD's daily chart. We're going to be mixing technicals with fundamentals today. And okay, making a start with the US dollar. I would note that Trump trades seem to be once again in fashion. There has been lots of hype over the past couple of days about Trump trades, and it's something which resurfaced. It was actually a hype also when Trump was up against Biden. It eased somewhat after Harris took over for the Democrats. It's back in fashion once again. The market seems to be increasingly pricing in the possibility that Trump will be getting elected. Such a scenario would theoretically at least provide some support for the USD, as on the one hand, it would be an expectation on behalf of the market for Donald Trump to follow a more isolationist economic policy, slapping tariffs all around. And that could be providing some support for the USD, while it could be weighing on emerging markets. That's one. The second issue I would be highlighting here is that there's still a wide uncertainty about the final outcome. And it's not only the fact that the difference between Kamala Harris and Trump is very narrow. We're talking about narrow in the level of a statistical error. And let's not forget that the presidential elections are being even more complicated by the delegate system, which is not as simple, where a simple majority doesn't cut it. You have to win majority at specific states in order to get a majority among the delegates which will be electing the new US president. So that makes it even more complicated. And I would be also highlighting here that it's not only about the US presidential elections. We have also congressional elections, and we may end up seeing, say, for example, Trump getting elected, but at the same time losing the Congress. While on the flip side, we may see Harris getting elected and the Congress remaining with the veto power of the Republicans. So if we were put it on a scenario basis, I would be highlighting 4 scenarios. The first scenario would be a clear red sweep with Trump getting elected as president and the Republicans having control over the Congress. That's one. Second scenario would be that Trump gets elected but loses Congress. So the powers will be rather limited and he will have to bargain. Third scenario, Harris gets elected but loses Congress. And fourth scenario, we have a blue sweep where practically Kamala Harris gets elected and at the same time maintains majority in both houses of Congress. So it's quite more complicated. And adding the uncertainty into the mix as well tends to more or less highlight the dangers of trading at that time. It's characteristic that, say, for example, we may see either contestant being elected, but the difference being pretty narrow, in which case we may see, for example, the candidate which failed to get elected not accepting the results. And in such a case, there could be some chaos, at least for short term after the elections. So it's a big issue. We will be keeping a very close eye on it. And definitely on the day after the election, we will have a live. So be prepared and keep your ears and eyes open here on this one. For the euro side of the pair, I would be noting that I think the bearish sentiment is still present. It's characteristic that the US dollar edged lower yesterday against its counterparts, but Euro USD's downward motion or downward direction seems to be maintained. You can see that from the downward trend line guiding the pair. I would be noting here that the price action has breached the 1.1005, sorry, the 1.0775 and the 1.0885. Now it's below it, and this support line has to be turned into a resistance line. And let's reposition all the labels, correct the contents, freshen up the look. We set the R3 at 1.1005, the R2 at 1.0950, the R1 at 1.0885. Mind you that this used to be a support line which has been broken, hence we switch its role from a support line to resistance line. The S1 at 1.0825, the S2 at 1.0775, and the S3 at 1.0725. Now there's a big question here in the following sense. A, the price action on Thursday, Friday, and today seems to have stabilized somewhat. It's characteristic that on Friday the pair even corrected higher, which tends to imply some stabilization and the respect for the S1 1.0825. On the other hand, we have the downward trend line which remains intact, so that's pretty valid still. And the RSI indicator which remains above but very, very close to the reading of 30, implying a rather strong bearish sentiment on behalf of the market for the pair. So overall, in our opinion, the downward motion could continue. Yet for a bearish outlook, we would require the pair to drop, break the S1 1.0825, and start aiming, if not testing, in my opinion, even the S2 1.0775. On the flip side, should the pair stabilize over the next couple of days, I wouldn't be surprised to see it breaching the prementioned downward trend line, which has been guiding the pair for the past 10 days or so, and respecting at the same time the R1 1.0885 and the S1 1.0825. On the fundamental side, for the euro, it's a pretty hard case for the bulls right now, given that, okay, there is a fundamental uncertainty about where Europe is heading to. And I'm highlighting here the political uncertainty within. On a macroeconomic outlook, okay, things are not looking that good. Inflationary pressures are falling, which is a positive. But on the other hand, we have contraction of economic activity, and that's quite troubling. It paints a rather gloomy outlook for growth of the economy of the Eurozone. I would be highlighting at this point the release of the preliminary October PMI figures, I think if I'm correct, they're on Thursday, which are going to be providing us an indication over where Europe is heading to. Should we see, say, for example, further contraction of economic activity, or if you prefer, a deeper contraction of economic activity for Germany's manufacturing sector, we may see that weighing substantially on the euro, as Germany was always considered to be the locomotive of Eurozone's economy. On a monetary policy level, I think ECB's interest rate decision on last Thursday, was very indicative. It showed the dovish tendencies within the ECB. I wouldn't be surprised to see the bank proceeding with more rate cuts in the coming months in an effort to provide more support for Eurozone's economy. It's something though which we will have to wait out and see, but in my opinion, chances are more likely that it will continue cutting rates than not. So overall, we see all three main factors weighing on the euro, and it's characteristic that the pair has been falling since the 27th of September, almost a month. Definitely the strengthening of the USD contributed to the fall of Euro USD as well. So it's not only the weakening of the Euro side of the pair, it's also the strengthening of the USD. Once again though, for a bearish outlook, we would require the pair to breach clearly the S1 1.0825 and start aiming, if not breaching the S2 1.0775, which provided support beautifully here. While even lower, we note the 1.0725. Okay, let's have a look at USD/JPY. We're going to be discussing mainly FX pairs today. However, if you have anything to propose, please feel free to mention it in the chat box, and if we have time, we can always cover it tomorrow, have a look, or today. Now, I'm going to be clearing the chart a bit and indicators list, the on-balance volume. I'm going to be deleting it. I'm going to also be deleting the Chimoku cloud. Close. I'm leaving the two moving averages and the relative strength index. And actually, you know what? I would like to have a look also at the Bollinger Bands. Okay. Now the pair seems to be rotating around the 149.75 resistance line. Actually, it has breached it today once again. So we're going to be switching this resistance line to a support line. It's only temporary, but still there. I'm going to be moving the resistance line on this peak here. Sorry. Locking it in, widening the chart, and let's open it. Correcting the label, starting with the R3, which is now being placed at 158.40. The R2 at 155.20. The R1 at 151.88. The S1 at 149.75. The S2 at 147.30. And the S3 at 143.45. So let's talk direction. USD/JPY bulls seem to have a relative fatigue. The curve is slowly turning here. We seem to be at a make or break point for the bulls. Either the pair is going to be reaching new highs, and for a bullish outlook in this case we would require the pair to reach if not breach the 151.88 resistance line, the R1, and that would mean practically a rise like a steep one, slowing the rise, and then regaining momentum and moving for higher grounds. On the flip side, should the bears take over, I wouldn't be surprised to see the price action correcting lower, and that would be shifting also the S1 to a resistance line, or if you prefer, lower the R1 and deleting the S1, setting out the new one. Actually, we could do that right now. Something like this. 150.30. Is the new R1. And I think that clears 140.30. That clears the picture a little bit further. It widens the resistance support line differences, but still. $143.45 becomes the new S2, and the S1 at 147.30. So practically for the bullish outlook to reemerge, the price action would have to breach above the prior high, i.e. break the 150.30. I'm setting the next resistance line. Actually, we could lower this and set it. You can see this trough here. Could go a bit higher, like this, where you had resistance here and support here and here. That's 154.70. So for the bullish outlook to be renewed, we would require clear break of the R150.30, while should the bears take over, I wouldn't be surprised to see the pair dropping, breaking the S147.30 and start aiming, or if you prefer, pave the way for the S243.45. Mind you that the RSI indicator remains pretty high. It's currently at 66, 62, 63. So that's an indication that the bulls may still have it and could push the pair higher. However, that's still inconclusive. We would require a clear break of the R1 before allowing for the upward motion bias to be maintained. Let's have a look at GBP/USD. GBP/USD seems to be in a make or break position as well. It's actually a bit volatile. It's currently testing the 1.3030 support line. It actually seems to be rotating around it. So that rather confirms the validity of the level rather than disproving it. The RSI indicator is below the reading of 50, some slight bearish tendencies, but nothing convincing just yet. For a bearish outlook to emerge for cable, I would require the pair to drop, break the S1 1.3030 and start not only aim, break also the S2 1.2890. While for bullish outlook, we would require the pair to rise and reach, if not breach, the 1.3260 resistance line. It's a beautiful resistance line which rests practically on this peak here, while there are two on this one. Let's have a look also at USD CAD. Now, USD CAD, it's an interesting element in the sense that there was this upward trend line. It was very steep. We had warned in advance about a possible correction lower at any point. And in my opinion, what we saw practically on Wednesday and Tuesday, let's have a look. Yeah, the 15th and the 16th of October, this being Thursday, Friday, today, okay. What we saw here is a mere correction lower. On the one hand, it shifts the upward trend line to the right, but the upward movement momentum, in my opinion, tends to remain. And I'm basing this practically on A, the fact that the downward motion was limited, B, the fact that the RSI indicator is at the reading of 70, implying that the bulls still have it. Yet for a bullish outlook, I would require a higher peak than the one on Thursday, on Tuesday. So the price action has to rise above the R1 1.3845, thus paving the way for the 1.3945. One small word of caution here. The RSI indicator being at the reading of 70, besides actually implying a strong bullish sentiment, which is correct, it may also be implying that the pair is at overbought levels still and could be stabilizing or correcting lower. In that case, I wouldn't be surprised to see the price action breaching the prementioned upward trend line, not just shifting it to the right like now, and stabilizing between the R1 and the S1, while for bearish outlook, I would require the pair to drop, breach the prementioned upward trend line clearly, as mentioned, signaling interruption of the upward movement, but also breach the S1 1.3720 and start aiming for the S2 1.3610. Once again, for the time being, we tend to maintain a bullish outlook. Also note how much room was created between the price action and the upper Bollinger Band. That allows the bulls to play around. Let's have a look at AUD/USD, which has been on the downward, and stabilized. Okay, the price action has clearly broken the S1 0.6705. Now we have to turn this into a resistance line. Let's go hunting for a new ultimate support line. And we have a beautiful touch here. Mid-October last year, it's 1 year low. 0.6270. Readjusting the chart. Starting with the S3, which is now being placed at 0.6360. The S2 at 0.6470. The S1 at 0.6570. The R1 at 0.6705. Mind you that it used to be a support line, it has been clearly breached. It's characteristic that the price action has used it even as a resistance line. The R2 at 0.6820. And the R3 at 0.6940. Locking everything in, the big question here is now, has the pair stabilized or are we expecting more to come. In my opinion, for the time being, it seems that the stabilization is taking place. On the other hand, I have to note also here that the RSI indicator is between the readings of 50 and 30, implying a bearish predisposition on behalf of the market for the pair, which could push it lower. But for the time being, it does not seem to be the case. For a bearish outlook to emerge, in my opinion, the price action has to start aiming, if not reaching, the S1 0.6570. Definitely, I would require a lower show than this one. On the other hand, should the bulls take over, we may see the price action rising, breaching the R1 0.6705, a level which provided resistance beautifully here. That was at the beginning of May. And next possible resistance line is being set at the R2 0.6820, which resides practically on this peak around the ending of August, beginning of September. Let's have also a look at the Kiwi. Now the Kiwi moves beautifully in a sideways motion between the R1 and the S1. On the other hand, the RSI indicator is telling a different story. It's saying that bearish tendencies is also possible. Yet for a bearish outlook, I would require the pair to drop below the S1 0.6045 and start aiming for the S2 0.5980. Now on the fundamentals, actually the Kiwi is quite interesting in the following sense. Now, we're going to be having the release of New Zealand's trade data tomorrow during the Asian session. Now, should we see a trade deficit which widens, mind you that the previous figure was at the minus 2.2 billion, that could weigh on the on the Kiwi. A little bit later, RBNZ Assistant Governor Silk, if I'm correct, will be speaking. And if the RBNZ policymakers sound dovish, which is quite the case given the last interest rate decision of the bank, we may see that dovishness actually weighing on the Kiwi as well. On the flip side, I would be noting China. We have some conflicting messages. On the one hand, we had PBOC actually delivering a single rate cut on the 1-year and the 5-year loan rates, prime rates, which was a continuance of the measures which are being taken by China to stimulate its economy. The big question here is whether the market's going to be seeing the rate cut as sufficient to actually get the Chinese economy up and running. In my opinion, not just yet. In any case, should the market start seeing that rate cut, which was delivered during today's Asian session, as sufficient, we may see some support building up for the Kiwi as well, given that New Zealand and China have very close economic ties, and it could allow for New Zealand exports to be enhanced towards China, thus more wealth flowing into the land to New Zealand. It's going to be quite interesting. For the time being, from all of us here at IronFX, best wishes for solid trading.
Okay, so as per usual, before we get started, just a risk warning. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer: the information in this webinar should not be construed as investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. And today we're going to be talking about IC trading. IC trading, yeah. So this is a trading strategy that is pretty unique. So here's our agenda for today. We'll talk about what exactly it is and then get into some of the key concepts, followed by understanding what exactly it is and how you can make use of it. And then we'll look at what smart money looks like in price action. So if you guys have any questions throughout the webinar, feel free to pop a question into the chat and I will be happy to answer them. Okay, let's go ahead and get started. So what is ICT? So basically ICT stands for inner circle trading. Okay, let me just allow you to pop your questions into the chat. Okay, so let's start by defining what exactly we mean by inner circle trading. So ICT, or inner circle trading, is a trading methodology that focuses on understanding the inner workings of the financial markets. So it involves analyzing market dynamics, identifying supply and demand zones, and utilizing price action analysis to make informed trading decisions. So it has now grown to become one of the most popular trading strategies around, focusing instead solely on price action. And it was originally created by Michael Huddleston to trade the forex market, but currently traders are using the same strategies to make profit in all and any market that they trade. So, yeah. So why exactly is it important for us to understand what ICT is? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give you a significant edge as traders. So by mastering the ICT techniques, you can enhance your ability to identify high probability trading opportunities and effectively manage your risk. So what exactly it is basically employing chart technical analysis and operates under the premise that by studying price movements, support and resistance levels, and order blocks, one can to some extent pinpoint the areas with the highest liquidity concentration and consequently forecast emerging trends. Okay, so let's get into some of the key concepts. Okay, so firstly, for our key concepts, we'll go through liquidity, followed by displacement, market structure shift, inducement, fair value gap, optimal trade entry, and lastly, balance price range or order block. So these are the fundamentals that you need to know in order to take advantage of trading in this style. So first key concept we'll go through is liquidity. So there are basically two types of liquidity. There's the buy side and sell side. So firstly, buy side liquidity represents a level on the chart where short sellers will have their stops positioned. So sell side liquidity is just the opposite of that. So it represents a level on the chart where long biased traders will place their stops. In both cases, these levels are found at or near extremes, as the tops and bottoms of ranges are often viewed where traders are proven wrong and therefore will want to get out of their trades. So here's an example. So smart money players understand the nature of this concept and commonly will accumulate or distribute positions near levels where mini stops reside. So you can see here, our sell side is on the bottom where the swing lows are, buy side is where the swing highs are. So basically it's where your resistance and your support levels are. So it is in part the sheer amount of stops at key levels, like those that I've just identified on this chart, that allow a larger player to fully realize their position. So once the level at which many stops are placed has been traded through, it's often that price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. Okay, so you can see normally at these resistance levels, you would expect price to reverse off of these levels. Similarly, for your support levels, you would expect price to bounce off of those levels as well. So that's just basically what we are trying to say over here. Okay, next, let's look at displacement. So displacement in short is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have large real bodies, so you can see in the image here, your strong selling pressure would look like these candlesticks here, which have large real bodies, very short wicks, like you can see here, and that kind of suggests that there is very little disagreement between buyers and sellers. And if we are looking at strong buying pressure, like the one we see over here, similarly, you see that the body of the candlestick is long, whereas the candle wicks are pretty short. So a displacement will normally occur just after a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. So we'll get into what those mean in a little bit. But basically what it means when we say a displacement occurs after a liquidity level has been breached is if you look at this area here, this is a multiple swing low support level. You can see price has recently broke out of that level. If you can imagine this horizontal line just over here. So it's broken out of it and is reversing off it now. And that is what is resulting in a strong buying pressure. So that's just basically what it means by a liquidity level has been breached. So if you think about it as what we've been going through normally, which is through your support and resistance levels, it's pretty easy to catch. But let me know if you guys have any questions so far. Okay, if not, let's move on to the next key concept, which is a market structure shift. So there are two major market structure shifts. It's just another way of saying it's a trend. So we have an uptrend, which is when the price is making higher highs and higher lows, and a downtrend in which the price is making lower highs and lower lows. So it's pretty straightforward, but if we are referring to something that we talked about previously, um, you can see in this example, we have swing lows. Yeah. So these sessions are recorded. I think they will be uploaded onto YouTube, but I'm not too sure. You can email IronFX. I think the email is on their website. So let me just check. But yeah, you should, if you email them, I think they will be able to send you the recording or at least give you the link to the right place. Let me see if I can find the email. Okay, I think if you go onto the ironfx.com website, you can just email them over here, support@ironfx.com. And I think they'll probably send you the link to this recording. Okay, sure, no worries. Okay, so where were we? Yeah, so when you're looking at market structure shift, it's important to find a market structure that has very clear movements in price. So if you look at the GIF that I've included here, there's a very clear price movement with swing highs and lows that are really significant. Okay, another example would be of a clear market structure. This isn't. Oh, let me go back to my slides. Okay, so this is the GIF that I was talking about earlier. So you can see that there are very clear movements in price with clear swing highs and very clear swing lows as well. If we look at this market structure, it's not as clear, but you can see that it's a very clear downtrend. So that's just basically what we're looking for over here. Okay, but typically we recommend you to look for a market structure that's clearer, something like this. Yeah, or something like this as well. So it doesn't have to follow a trend line. So over here you see that we have four um four swing highs that line up on this trend line. And it doesn't have to line up on a trend line. I'm just using this picture to show you what you can look out for. So here you see that we have um higher lows, or rather lower highs, since it's a downtrend. Okay, so next key concept we're looking at is the inducement. So rarely does the price move in a straight line. So within a larger trend, there are almost always counter-trend moves. These counter-trend moves are the results of lower time frame liquidity hunting. So let me show you an example. So if you see in this example where we have identified the market structure shift, it's basically when price has broken below this swing low. Okay, so that's a market structure shift. The inducement is when price has bounced off, which is over here, bounced off and is reversing off of a new resistance level. Okay, so the price will bounce or get rejected and then will target a previous short-term high or low before continuing in the same direction as the longer-term trend. So the short-term high in this case is here, all of the circles over here. Okay, and then it continues in the same direction. In this case, it's a downtrend in the longer term. So, yeah. So inducement is specifically targeting these short-term highs, like those that we've circled, or short-term highs or lows as areas where these stops might be placed. So because you're expecting price to reverse off of these circles, you might decide to place your stop loss right above these levels here. Okay. Okay, now next key concept we're looking at is the fair value gaps. So these are created within the displacement, and are defined as instances in which there are inefficiencies or imbalances in the market. So if we visualize what this means, it's basically a three-candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not overlap. So let me show you an example of this now. Okay, so if we look at the fair value gaps that have been filled, okay, you can see that these, if you follow the arrows, right, the fair value gaps are basically the levels in which price has retraced and is testing that level again. So it's basically what we previously mentioned as um, overlap resistance or support levels, or in this case, it's support overlap areas. Okay, so you see price reversing, testing that level, bouncing off of it. Similarly, price reverses, tested that level, and reversed off of it. And same thing over here. So in the example that I have here, the fair value gaps that are unfilled are basically the levels that don't reach that same level or the same areas from the previous price. Okay, I hope that makes sense, but you can just look at the chart, the example that I have here. Okay, so maybe to start off, you can look for what we've mentioned in the previous slide, which is the three candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not overlap. So you can look for some of those examples in over here. Okay, so next let's look at optimal trade entry. So the optimal trade entry represents the best places to get into a trade, and they can be identified by utilizing the Fibonacci between 61.8 and 78.6. So maybe I'll show you an example. Our previous webinars recently were on Fibonacci, but if you missed that, I'll just briefly go through it here. Let me just pull out my, let me just show you guys a website. Okay, so if you missed our Fibonacci series, not to worry because we'll probably go through that again. But because we recently finished that, so it might be a while. But anyway, so the website that we recommend you to go through is theforexarmy.com, and it goes through how exactly to draw a Fibonacci retracement correctly. So there are some videos that you can take note of, the market structure to keep an eye out for. Okay, so if you're looking at using the ICT to find an optimal trade entry, they recommend to use a Fibonacci between 61.8 and 78.6. So although we typically use these levels, you would just be looking at these two levels here. And how that works is basically by looking at the highest starting point to the lowest, okay, or like something here. Shows you the invalid as well. Yeah, but you can just go ahead to this website and take a look. Okay, I think I'll just pop it into the chat. Oh, we have a question. Okay, what happens to FVG that has not been filled? So if we go back to my slides, basically what it means when it's not filled is that we don't expect price to return back to that area anytime soon. So we are not going to use those levels as, we're not going to take note of those levels. We want to take note of these FVGs that have been filled in order to place your stop losses and your take profit levels, yeah, according to those levels. Okay. I'll show you guys on TradingView, there is an indicator that helps you to find FVGs. So it's probably the easiest way to spot those, but I'll show you in a little bit. Okay. Yeah, I was talking about optimal trade entry. So the link that I've popped into the chat basically goes through the fundamentals of how to draw a Fibonacci, which I'll briefly go through here as well. So this is a Fibonacci retracement checklist. So firstly, you want to see is the market structure clear? So we showed you previously how to identify a clear market structure. Next, we want to look for the recent trend, so are prices going up or down, and it's important to always follow the general trend. Next, we want to identify recent major swing lows and swing highs, like those that we've identified previously, and then connect the two extreme points like we have done over here. So since this is a downtrend, your starting point is at the swing high and your ending point is at the lowest swing low. Okay, here you can see all the different Fibonacci numbers that we mentioned in the previous slide. So for the ICT, we are focusing on 61.8 and 78.6. Okay, but it's basically the same thing. Here's another example. So we are looking at the level at which price bounces off either your 61.8 level or your 78.6 level. Okay, now let me get back to my... Okay, so after optimal trade entry, the next key concept is a balanced price range or imbalance. And this is the result of an aggressive move up that's immediately followed by an aggressive move down, or an aggressive move down that's immediately followed by an aggressive move up. For an uptrend, do we start the Fib 0 at the bottom or the top? Okay, I'll show you in a bit. Do I have it here? Yeah, so like something like over here, we would draw your starting point here and then your ending point would be here. So your 0% would be at the top. Okay, yeah, balanced price range. So what's left after either of these instances is essentially a double FVG or fair value gap, which can act as a magnet to the price before a continuation move higher or lower. So balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from those areas. Okay, so now let's look at what smart money looks like in price action. So SMC trading involves looking at order blocks, which is a refined version of supply and demand of an asset, and then your breaker block or mitigation blocks. This is what is traditionally called your support and resistance. flip zones, and then your FVGs, which are imbalances on the market. So when demand outpaces supply or vice versa. And then lastly, your liquidity gaps, which we went through before, are basically the areas in which um, there is a support level or a resistance level. Okay, now let me pull out my charts. Okay, so if we are looking at DXY, just a random chart, how you basically implement the FVG indicator, okay, is okay, you go to the indicators, search for fair value gap, and this one. Okay, so this helps you to identify any of the FVGs. Okay, and you can use this on any time frame as well. So I'm on the 1 hour time frame now. Okay. Yeah. So the one that we use is the Luxel Gold one. This one here. This one. Lux Algo. So this automatically helps you to find FVG on any time frame, and it will help you to highlight the level as well. Okay. Okay, so you can actually use um these key concepts more as like a checklist when you're using the ICT trading strategy. So firstly, you look for the liquidity, followed by the displacement, look for any market structure shifts, inducements, value gaps, and then use your Fibonacci levels to find your optimal trade entry, followed by followed by the balanced price range, which is basically looking for a double fair value gap over here. Okay, let's look at this example maybe. Okay, if I can find a double fair value gap, I'll show you as an example. But one of the websites we used, okay, let me just share that website with you. Because this is quite a niche trading strategy. So I'm just gonna share all the resources that we use. Um, So basically what I mean by a double fair value gap, so you can look at this website as well. But basically this is what we are looking at. Okay, so we have a balanced price range up here, which is essentially where price rebounds off of a resistance level. It drops and then it tests that level again. Here it says price testing and rejecting your VPR. Basically, if you were here for our support and resistance levels, we're just talking about a double swing high here. So it's just basically where the level is reversing off of that same level before, the same resistance level as before. Okay, and the reason why we are highlighting this entire area is because that's basically where we see price being attracted to. So it tends to be attracted to such areas and then reverses off of it. Okay, let me go back here. Okay, if we go back to the, yeah, to my chart here. So you can see that our fair value gap is in this area here. Okay, we have this green highlighted area, which is in line with this swing high. If we look at this fair value gap highlighted here, this is in line with this resistance area here as well. Okay, so we're expecting price to continue to rebound off of this area, and drop below it. So that's for resistance levels. We're looking at support levels. Here we have a swing, a couple of swing lows that match up with swing highs. Okay, so this is one swing low, two swing lows, and then a swing high, right? So this is a pretty significant level, and using your fair value gap basically helps you to highlight any of such areas. So like I mentioned earlier, these are not really specific levels, they're more so areas. Okay, and if we use, let's see if we can make use of our Fibonacci levels as well. Okay, here we see that we have a nice 38.2 that lines up nicely with this area. Okay, if I look at our 61.8 as well as the 78.6, okay, you can see that that also lines up with the highlighted fair value gaps over here, okay, as well as the 78.6 doesn't really, apart from this swing low, it doesn't really match up, which is fine. It doesn't always have to match up. So you can see that this 61.8 is a pretty significant level here. Okay, the reason why I say it's significant is because we have one swing low, two, 3, and 4 levels that are lining up. So we can expect price to be attracted to that area again and then bounce off of it. Okay. Yeah, I think that's all the time that we have for today. Again, so sorry for the delay because of the time mix-up. Um, but yeah, let me know if you have any other questions. Um, yeah, for with regards to the recording, the email is on the IronFX website, and you can probably get the recording from them. And next week we will be going through the second part of this ICT series. So yeah, stay tuned for that. Yep, I think next week we will start the usual time. So there won't be any scheduling mix-up again. Yeah, but so sorry about that. Thanks everyone. See you guys next week. Bye.